that intro. So I'll start with a little bit about my background because I kind of feel it's useful to know where people are coming from, and then I'll jump right into what the sustainable finance ecosystem looks like, where it's evolved from, what the main who the main players are, what the main forces at work are in terms of shaping demand for services, and then I'll go into the type of work that happens in sustainable finance, and talk a little bit about the career paths specifically within the asset management industry, and a bit more kind of beyond that. I know that there's quite a few people with technology background on the call, so I will try to make it as relevant as possible. Do post questions. I'll try not to talk for more than about 20 minutes, and hopefully that will leave quite a bit of time for Q&A. So as you mentioned, I've been working in sustainable finance throughout my whole career. I did 2 master's degrees, one in international relations, specializing on finance, and then realized that I wanted to work in sustainability, but didn't quite know what the angles were. So I decided to do another course specifically in sustainability, and I did a master's degree in carbon management at Edinburgh University, which is kind of part business school, part School of Geosciences. So it was the first year they were running it. I was back in 2009. But the interesting part there was it was a hybrid between the science, specifically around climate change, and how business decisions are made and how they can be subsequently influenced. And since then, I worked in a Dutch ethical bank. I worked for a small startup that ran a series of low carbon indices with FTSE and S&P, which are two of the big index providers, and effectively built a methodology for around 12 low carbon indices. I subsequently moved to the asset management industry for a few years, worked quite a lot on policy engagement with policymakers, ministries of finance, regulators in the run-up to the Paris Climate Summit. After the Paris Climate Summit, I worked in an NGO and Climate Bonds Initiative. I did that for just over a year before I joined the Cambridge Institute for Sustainability Leadership, heading up the sustainable finance team, which covered banking, investment, and insurance industries. I worked very closely with industry. It was a kind of think and do tank on various types of solutions. And as of 2020, I moved back to the private sector and worked in an asset management firm again. And in my current role, I work the broad set of stakeholders within the firm and without, mainly on the income side of the business and the multi-asset side of the business, on increasing the quality of what we do on ESG, but also very much focused on creating new sustainable investment products. So very much kind of hands-on type of role at this point. In terms of the sustainable finance ecosystem, it has a very interesting story, which is very much linked to the theory of change of people that were that have been involved in it for, and I think that the key thing to look at maybe are the kind of milestones of how the industry's evolved. Sustainable finance is really nothing new. I think some of the oldest sustainable funds are ethical funds that you might find are something around 35 years old. One of the ones that I worked on in Bank of Montreal was 38 years old. It was one of the first in the UK, one of the biggest at the time. But ethical funds were very much based on ethics and value systems, and very often those are funds that were that had certain kind of moral restrictions around them. So they were they would not invest in tobacco, they would not invest in alcohol, adult entertainment, weapons, things like that. So they made kind of moral decisions to abstain from certain types of investments, but everything else was pretty much up for grabs. Things changed around 2010 when carbon accounting matured. This was, I'd say, maybe 2005, 2010, because in 2005 you had the launch of the European emissions trading scheme. So you had carbon accounting, carbon had a price. So it was a lot easier to actually move beyond just ethical considerations and quantify environmental considerations, to kind of put it in general terms. And with that quantification, and the fact that you could associate a price to a ton of carbon, tons of carbon were fungible, in the sense that it didn't make any difference where the ton of carbon was released or where it was sequestered. There was also a market in carbon credits, so offsets, both in the regulated compliance market, mainly for the EU emissions trading scheme, and the Kyoto Protocol transactions, but also on voluntary basis, and that market still exists today. So you had a price for emissions, you had a price for sequestration, and you can start doing some sort of climate risk modeling. And the key point here is that you were able to translate an environmental good or environmental damage into profit and loss, so into the language of finance. And another key contribution there was an article in the Rolling Stones by Bill McKibben, and work that was done by the Climate Tracker Initiative, Carbon Tracker Initiative, around this concept of a carbon bubble. And the concept is actually quite simple, and maybe that's why it's powerful, which is if we're going to keep temperature rise to a certain limit, let's say it's 2 degrees or 1.5 degrees, as is currently being pursued through the Paris Agreement. If you're intending to limit warming, that effectively gives you a budget of how much carbon emissions humans can put into the atmosphere to cause a specific level of warming, right? So if you go backwards from that, we know how much we can emit, and we also know how much carbon there is in the reserves of fossil fuel companies that are listed on various exchanges, right? So we know how much carbon is treated as financial assets on the balance sheets of various corporations around the world. And it turned out that when you compare those numbers, there is 3 to 5, depending on the level of warming that we're talking about, depending on the way you calculate, 3 to 5 times more carbon listed as financial assets with values attached to them, 3 or 5 times more carbon than we can emit and stay within 2 degrees warming. So that terrifying math, as Bill McKibben put it, is the basis of the carbon bubble, that there's more kind of asset, and the bubble is a kind of financial term, that actually we're overvaluing fossil fuel companies because actually they have assets on their balance sheet that we cannot burn. So they're stranded assets, and this concept of stranded assets, carbon bubble, really kind of hit home in terms of the financial system, and importantly, the regulators that have subsequently, since 2005, when policymakers have effectively agreed to commit to a reduction in emissions. Since that stopped being hypothetical and started being planned for through the Paris Agreement, regulators have stepped in to say, okay, if this is going to happen, there might be financial risks in the financial system, so we need to improve disclosure, and we need to ensure that financial market participants, like investors, like insurance companies, like banks, take these risks into account. So that subsequently has led to a deluge of regulation And there's so much regulation and regulators involved in putting out climate risk type pieces that there's even a club, the Network for Greening the Financial System, NGFS, which is a group of central bankers and group of regulators that are working on this together to create some sort of level of consistency across the policy landscape. So that is ramping up. That's definitely a force for change, and it's forcing now pretty much the whole financial industry to at least take note of climate change risks, ask for data, ask for companies to minimize this risk, and that is often leading companies to set net zero targets. Is definitely leading to better climate accounting, and things of that nature. It is, I think, important to distinguish, however, that this is managing your financial climate risks as a financial institution or as an investor is not the same thing as reducing emissions. And sometimes it might be, sometimes it might not be. You might find that there are oil and gas companies that can produce oil so cheaply that they're intending to produce oil forevermore. And they intend to do so because even in a low carbon scenario, it is expected that we'll need some oil. And they, for example, might apply the strategy of being the last producer standing. So it's not exactly the same. And in general, ESG isn't, so this move from ethical investing to ESG investing, environmental, social, and governance investing, is not the same thing as, for example, impact investing that does explicitly try to change the world. ESG is very much, if I can simplify it, because it means a lot of different things to a lot of different people, but in gross simplification, it's a process of integrating financial risks from environmental, social, and governance considerations. Some funds will be promoting, which is quite a loaded term in the regulation that's coming through Europe at the moment, but they're promoting certain ESG characteristics. And what's meant by that is that the companies within an investment portfolio will have kind of higher standards to meet in terms of environmental efficiencies, social practices, and governance standards. So a few words just on impact investing. Impact investing does claim to, and it does make the claim that it's effectively driving change, or at least investing in companies that are driving change. And it stemmed from the private equity space, which is a segment of the investment industry that invests in companies that are not listed. So venture capital is kind of in that bucket, but that's kind of smaller companies. Private equity is you already have shares, but they're not listed. Typically, you're taking a much larger share of the company than in the listed equities or corporate bond space. And it kind of emerged from there to now also encompass financial products that are in the listed space. The key thing there is this aspect of causality, where you're typically attracting clients and investors who want to see a change in the world. That is not good enough for them to just own companies that are better than average, or better than a certain standard. They want to see change in the real world. But this element of causality is actually quite important. And a lot of the feedback, maybe we'll get into this in the questions, but a lot of the criticism of sustainable investment that's come out recently, you might have seen this in the press, is that there is this element of causality between the investor investing money into a fund and then the fund investing in a company, and then the company at that point doing something that changes the world, that element of that chain of causality doesn't always hold. And that's just because of the nature of investments. It might be the case that you're investing in a company that's already made the change, and you're just buying the asset that already exists. So in that sense, it's difficult to claim that you've made the change by allocating capital to that fund that subsequently bought an asset that's already standing. But it might be the case that that's good enough for the investor, that the investor ultimately will end up with a portfolio that is associated with change having been made, or with green assets only, like renewable assets that are already standing. And in my opinion, if you're trying to kind of unpick this kind of causal element, it's easy to miss the big picture in that there are certain types of assets that are making change in the world. And by being part of the financial flow and financial system towards those types of assets, you are in aggregate making a change for the better. I think it's kind of found a comment on this causality aspect. I think it's some of the expectations of financial products and how much change they can affect, I think has been a little bit overstated. There's a limit to how much you can do with just preferential financing. A lot of the things that happen or don't happen in the real economy are actually down to just relative pricing of various technologies, policies being put in place, efficiency or performance standards being deployed in certain markets. And I think that is fundamental technological progress. Those are the fundamental forces that actually affect change in the real world. And financing kind of is a part of that, but it's definitely not the determining factor in nearly any sphere of economic activity. And I think as investors, we need to be kind of clear-eyed about that. Nevertheless, it's the sustainable finance market is now roughly a third of assets under management globally, which is shocking to me. Bearing in mind that I've been in the industry for 14 years, I never thought it would touch a third of assets under management. When you hear that figure, almost all of that figure is something that's called ESG integration, which basically means that though that capital involves looking at ESG risks and opportunities, but it's not trying to outperform or have kind of positive ESG characteristics. Those types of funds make up roughly the figure that I saw published this year is 3.2 trillion assets under management, which is a very big slice of a very big number. However, in terms of what proportion that is of global assets under management, it's roughly 1.5%. To 2%, depending how you count. So it's still niche, and it's 80% in Europe, another, let's say 15% in the US, and roughly 5% kind of rest of the world. But it's growing very rapidly. It roughly doubled in 1 year in 2019 and 2020. The number of funds, number of sustainable funds is in 2020 was roughly 4,000. I think last year it probably went up to 6,000-ish if I was to estimate, but I haven't seen data on that. So it's a very rapidly growing area. In terms of the main players in sustainable finance, as you can imagine, banks, insurance companies, investors. Out of those three, I'd say investors are probably a decade and a half ahead of the other two. In terms of how data flows. Another way of looking at the kind of sustainable finance industry is from the perspective of data flows through the industry. And you can kind of categorize them into three broad buckets, which is data preparers, data providers, so the middle people, and data users. So anybody that has to aggregate sustainability data and give it to their client is a data user. The final client could be the end investor, it could be the regulator. And data providers in the middle aggregate information from the data preparers, and the data preparers themselves are typically companies. So companies, but also companies like myself, like an asset management company. We are also a data preparer for our clients, the asset owners, and we will be preparing reports about our holdings to them. So an example here of a data flow will be a company like Exxon. They will prepare data and put it into their ESG report. They will provide that data directly to a data provider like Sustainalytics or MSCI. And when we look at that data, we very rarely would go directly to ExxonMobil because we want to get the data for all of our holdings. And the company I work in now is not a good example because we have very concentrated portfolios, but a typical investor will have to deal with thousands to tens of thousands of companies or assets that they have exposure to, and they'll need data from all of them. So if you imagine just the carbon data itself, and there's other type of data like social data, water, tons of air pollution, just tons of environmental figures, types of environmental figures, governance, data around board composition, diversity, independence, tenure, tons of different things. If you think about that multiplied by 10,000 companies across your holdings, that's a massive data project, and you're getting updates all the time, and you want snapshots, you want to manipulate that data, and that's where these data providers come in, because they are able to aggregate, standardize data for the consumption of data users like ourselves, and they enable us to get a portfolio level view in aggregate of what's happening, what would happen to our aggregate average figures of a fund. And a lot of funds will have different targets around these figures. So carbon emissions is a classic one, where a fund will want to have their carbon emissions of the fund, so it's the average carbon intensity of the fund, to be below that of the benchmark, which requires constant monitoring of both. So you want to be monitoring the carbon intensity of the benchmark, you want to be monitoring the carbon intensity of the aggregate companies in your fund, and also do various types of scenarios on it. So what happens if I sell a company? What happens if I buy a company? And you want those types of data solutions to be live. And data providers provide some of that, but increasingly investors want to have that in-house, because they're realizing that actually full control of being able to manipulate that data, prepare it, do what if scenarios, and delve deeper into the different aspects of the different ESG aspects of the companies that they hold is becoming increasingly important, especially now that the expectation is there to not only measure the ESG risks, which, being investment risk, have quite a lot of depth to them, but also manage those risks through engagement with the companies. So if I'm, as an investor, wanting to engage with a company, I want to prepare for that engagement. So I want to understand the company through and through. I want to understand its trajectory. I want to understand its positioning relative to peers. All of that takes tons of data and analysis. And so there's an increasing need to be able to collect, manipulate, report on various types of data points, and I'll get to that in a moment when I talk about different types of roles in the industry. Just quickly about kind of the main forces affecting the industry. I guess historically the main force has been clients. So ethical funds had been set up initially by people who just didn't want to invest in certain types of companies. A lot of religious groups started up initial kind of first generation of ethical funds. Quakers were quite active, but today you have Sharia funds that reflect Islamic law and Islamic values, and various other types of value systems. So clients are definitely asking for this with sustainable funds and impact funds. The main demand, the main force is really clients asking for this, asking for these types of financial products, and financial institutions subsequently wanting to take advantage of that demand. And in fact, last year, when I was looking into the numbers, in some parts of the investment industry, all of the new fund flows, so new client acquisitions, were in sustainable funds only in a given market segment. In aggregate, in terms of broad flows, roughly a third of new clients, positive fund flows were into sustainable funds. So that client demand is, I couldn't overestimate it in terms of the force that's powering the shift in the financial industry, which is profound and subsequently kind of drives what the financial industry expects of companies that it provides capital to. So that chain of action is very strong. The second kind of aspect that's changing the industry dramatically is regulation. So the regulators are trying to do two things at once. One is standardize things. So standardize disclosure, make it comparable. This is mainly affecting companies that are preparing ESG information. So there are various standards that have come out. The Global Reporting Initiative, GRI, is a very kind of well-established standard. The SASB standard, which is the Sustainable Accounting Standards Board, has been a very, very strong standard. It has now actually been acquired by IFRC, which is outside of the US, the main accounting standards body. So this is now kind of going from just a sustainability, group of people that are setting sustainability standards to actually being part of the accounting ecosystem, which I think is going to be very, very powerful. So the regulators are trying to standardize what they can, but also kind of shake up the industry so as to remove some of the greenwashing and some of the kind of cowboy era, Wild West practices that have been happening in the industry, simply because it's new. Whenever you have a new kind of industry, things happen, things evolve, various practices become standard, but it takes a while for an industry to be able to be standardized. You don't want to standardize a new industry too quickly because you don't know what works, what doesn't. So we're now in the phase where we know what works, we know what doesn't, we know what's not quite great. And the regulators are kind of coming in, calling out greenwashing and challenging the industry to actually set some clear guardrails, which is healthy and just part of kind of new frontier industry. The other driving force is NGO third sector, calling out greenwashing, setting higher expectations, keep drumming about whether or not what the industry is doing, both at kind of corporate level, financial level, regulatory level, is good enough to meet sustainability goals, like the climate goal. Another big one is service provision. So the service provider industry. So I mentioned Sustainalytics, I mentioned MSCI. MSCI is a very big player and always has been. It's a big index business, and they've been kind of active early in the ESG space. Sustainalytics is also big, but they've always been only about sustainability, and they just a few years ago got bought by a big index company called Morningstar. And in general, there's been a lot of consolidation happening with the big companies that are established in this industry buying up sustainability data providers, specialist sustainability data providers. So S&P bought TrueCost, Moody's bought 427, which is a physical climate risk outfit recently. I think Moody's also bought Vigeo Eiris, which is one of the first ESG data providers set up in the 80s. Lots of stuff like that. So if you have already established a specialist kind of boutique ESG data company, you've probably already had big companies trying to buy you. If not, you're about to be visited by somebody that will want to buy you. So there's a lot of demand for good, insightful solutions that break through the noise of the data, are able to aggregate, come up with good insights, and go from data to information to knowledge, and go up that path. So just a few comments on the types of roles and just kind of entry points before we go into Q&A. I realize that I've been talking for 50% more than 20 minutes, but hopefully it's been interesting so far. In terms of types of roles, very broad church. The finance industry is quite big, and and ESG is touching quite a lot of different aspects of it. Traditionally, in the asset management investor kind of business, you would have ESG analyst teams. It used to be that they were quite centralized. Now they're more often distributed, and they work within different investment teams and on specific funds. And it used to be that an ESG analyst kind of did everything, and nowadays it's a lot more specialized. So the typical tasks that are involved with an ESG analyst involve assessing companies, engaging with companies, preparing various types of data disclosure, voting, which actually was probably one of the oldest tasks that was in the realm of responsibilities, and also regulatory and legal compliance. With the amount of legal compliance, with the amount of companies that you need to vote on, with the amount of research and engagement and data manipulation that you need to do, nowadays a lot of those functions are split out. So a lot of asset managers will have dedicated ESG data team. That will be anything between 2 to 15 people, depending on the outfit. Very often the compliance and regulatory bit will be a separate team. Very often the voting will be a separate team, and reporting and preparing data for reporting will also be a separate team. And the research and engagement will be still the bread and butter of a typical ESG analyst. But as I said, that's specifically for investment and insurance. For an insurance company, you'll have a similar breakdown, probably around compliance and so on. But you'll have a lot more work to be done around underwriting, physical risk, natural catastrophe modeling, stuff like that. That's actually very interesting. Within banks, this is still very much evolving, how banks are structuring their teams, but similar breakdown. But banks are a lot bigger than either insurance companies or investors. So they'll have a lot more types of roles depending on the segments that they cover. just in terms of the scale of hiring, the last 2 years, I've never seen anything like it. Most teams that I know of have doubled or tripled in size, which is bizarre. If I think about it, and a bit shocking, but at the same time, there's demand. There's just so much demand for sustainability products and regulation that's coming through that there's tons of work in the space. PwC, which is one of the big 4 consulting companies, said that they're hiring 100,000 people just to work on ESG, which is a shocking number. Their competitor Deloitte is saying that they're going to be training all of their 300,000 staff, 300,000 in ESG. So this kind of reminds me of the figure that I heard mentioned by the CEO of LinkedIn that said that by 2030, 2035, I can't remember, 70% of all roles will be sustainability roles. So maybe this is in part just that kind of trend of sustainability touching everything. How do you get in? It kind of depends which type of role. For typical research and engagement analysts, there's often a requirement to have some sort of ESG element to your previous experience, either working on ESG within whatever team you were working in before, or being an ESG consultant, or working in an NGO, or something like that. In terms of ESG data, very often there are people hired with no previous experience of ESG at all, and your data skills are kind of the primary thing that gets you in, and you're expected to just learn ESG on the job, maybe do a course. There are a few courses out there, quite a lot of different courses out there that you can do. In the finance industry specifically, the CFA in the UK has a specific ESG course. Both Cambridge and Oxford has specific sustainable finance courses. So it's not that uncommon to see people with no prior sustainability experience get jobs in sustainability roles just because they have transferable skills that are required. It's 40 minutes in. I will stop talking and maybe take some questions.
Sounds good. Yeah, thank you for this overview, Kajetan. I am going to add myself to the spotlight, and we have so far one question from Jennifer Wang. Jennifer, do you want to unmute yourself and ask it?
Sure. Thank you so much, Kajetan, for your presentation. That was great. So this is kind of like a visioning exercise of like sci-fi. Like, what would be your vision or view of what you think the sustainable finance industry, or finance, maybe it's just finance, or maybe it's just sustainability, will look like in 10 years, 20 years, 50 years? And I know it's like hard to paint a picture of all the details, but like, what are the key things that stand out to you and your visioning of it?
Yeah, that's interesting. So I would hope that at some point, I would hope that within 10 years we stop talking about sustainable finance, we just talk about finance. But I think the sustainability element is here to stay. So you'll always need people with specialist knowledge that can answer tricky questions. The trend that I'm seeing is that in general, you want, at least in the investment space, but I think it's the same thing is happening in underwriting and in banking. You want the people that are making the decisions, so in the investment space, like the investors, the fund managers, to have enough clout around sustainability to be able to integrate it into their own head. In the beginning, what happened, 10 years ago, is that the sustainability element was always a bolt-on, and the fund manager would just simply make financial decisions, and then ask the sustainability analyst whether or not the company is or is not sustainable. It was very binary. And then once it was fair game to just go in. Whereas now it's a lot more nuanced. So you say, okay, it's not black and white. It's actually very gray. And they're a little bit unsustainable here, but a little bit sustainable there. But they have targets to improve. But we don't trust the management. Right. So it becomes a lot more fluid. But I think it's still such a big sphere of knowledge that you will end up having to have people that are experts in the field, and also know where to look for the data, how to crunch it, how to get from the noise to insight. So I'm hoping that we're just going to have finance and sustainability is going to become a part of it, just like today you have compliance, I guess, as a part of it. You know, the legal team is a part of finance. You have tons of people that work in finance that are not, doing lending, underwriting, or investing, right? But they're part of like the ecosystem, and they're experts to lean on. That said, I have the same hope for organic food. I wish we just have organic food, and the unorganic food was just called non-organic food, but that's not really happened. So there's a difficult moment where something niche goes into the mainstream but doesn't quite take it over. I'm hoping that's not going to happen with sustainable finance, but I think it might. And the fact that we still only have kind of 1.5% of finance that's specifically explicitly trying to promote sustainable companies means that it's still niche. So I'd hope that that's in 20, let's say 50 years, I'm hoping that that 1.5% becomes 50, 60, 70%, and that regulators and politicians, because fundamentally this is the politicians, will say, okay, the sustainable means and ways of production and consumption are so big and mature enough that we can envisage running whole sectors in this way. So let's promote those types of businesses, and let's wind down the stuff that is unsustainable and that we don't want in our societies. But that is premised on politicians, A, having the courage to do stuff like that, and B, the institutions being strong enough in the main economies to make that shift. Because and currently, I think there's, if you take the US as an example, Democrats want a low carbon transition. The Republicans think climate change is a hoax. And so there's, the willingness is kind of 50-50. And the second element there is, do we have strong institutions that will withstand the test of coordinating and shepherding such a massive industrial transformation over a very long period of time, where there will be winners and losers, and you have to have transfer of benefits. You can answer that yourself, right?
Thank you.
Yeah, thank you for this answer, Kajetan. So we have a couple of questions. I want to focus mostly on questions having to do with how to work in this area, rather than just understanding the area broadly, because that's what Work on Climate is mostly about. So, for example, Alison Whitaker is asking a question about that. Alison, do you want to unmute?
Hi, thank you for this presentation. It's been quite interesting to me. I'm wondering, what are the most important concepts that people working in finance need to understand to be the most effective that they can be in sustainable finance?
Interesting question. There's a lot of them, so I'm trying to rank them in my head. I think the main one is trying to understand how to get a handle on sustainability risk. So there are different kind of types of risk. So understanding what they are and how to quantify them and how to understand them is one way, one important aspect. The other concept is this concept around materiality, which is linked to risk. So how much of an impact can something have, whether or not it's going right or wrong, right? And so just maybe provide an example around that. If you have a number of energy companies in your portfolio, and they have different emissions profiles, and you expect to be, and you're a long only investor and expect to, be engaged with these companies over, over 3, 5, 10 years. And that there's a carbon price coming that's going to affect these companies. It's quite easy to determine who's going to win and lose from that. And it's quite easy to understand by how much. So if there's an energy company that's zero carbon, it's not going to get affected by the carbon price, whereas a company that's emitting quite a lot will have to pay for those emissions. You know how much they're emitting today, because that's in their disclosure. You know what you can expect. You can make estimations in terms of what the price is going to be of those emissions, and you know how much that cost will affect their profit margin, right? So that's a very kind of classic example of financial risk from climate change. There are other things that are more difficult to price in, but basically the scale of that impact onto the company's financials is, the materiality of the financial risk. There's a second concept linked to materiality, which is sustainability materiality. And there's a difference between kind of financial materiality and sustainability materiality. Financial materiality is basically everything that can have an effect on the company's enterprise value. And sustainability materiality is all other things that are kind of sustainable in nature that don't have a direct effect on the financials, but they're also material. So if a company is working in I don't know, a region where human rights abuses are generally tolerated by the government, and the likelihood of them kind of being found out or having to kind of pay any type of fines is very low / non-existent. There's very little kind of financial materiality, maybe brand damage if it comes out, but there are a lot of companies that don't really rely on their brand to make money. And everybody knows about the issues. So you can say that financial materiality is very low or non-existent, but there is a sustainability materiality because their business model is involved in human rights violations, and you might not want that in your portfolio. So understanding materiality is I think another concept to look at. Yeah, I think those are the main ones.
Oh, yeah. Thank you, Kajetan. One more question, if I may ask on myself. So if someone wants to work on climate, how should they choose that this is the right sector for them to work on, as opposed to all the other sectors they might be working in?
Yeah, it depends on where you are and where you want to go. I mean, the sustainable finance industry is definitely going through a boom. And there's coming back to your question. I mean, when making decisions like this, I often think about the saying that if you're not sure what to do, do what you can with where you are and what you have. So the finance industry isn't for everybody. It's some people like the fact that like the type of work and the culture that kind of goes with it, and the kind of scale and the access and so on. But it is very often juxtaposed with quote unquote the real economy, right? In a sense, kind of finance is like unreal because it doesn't actually do anything. It just kind of helps things happen. Things that don't get financed don't get done, for sure. But at the same time, if you're interested in kind of being in the cutting edge and kind of hands-on, very kind of hands-on role and hands-on company, then maybe the fact that within the finance industry you're always one step removed from the real world might be annoying for you. On the other hand, if you don't mind that, finance does provide an element of scale. So for example, if you're working in a specific company, let's say it's an energy company, and you can take a lot of pride and job satisfaction from helping that company move from their existing business model to a sustainable energy provider. There are a lot of examples of this, like Iberdrola, NL, and others. That's super interesting, but you're still working within the restraints of that one company doing what it does, where it does, with the capital that is available to it. Whereas in the finance industry, you can move between sectors, and very often you're doing work on very different sectors from one week to another. So in investment, you could be working on a mining company, and a couple of weeks later you can be working on an internet-based company, or something completely different. So that variety is actually very interesting. The perspective that gives you on the whole economy is also quite interesting. The fact that your work can scale is quite interesting, because you might start working in a fund that is a couple $100 million, and then the fund might grow, or you might start working with multiple funds, and suddenly you're involved in an operation that goes into the hundreds of billions of dollars, which is which can change the dial in many markets. And the conversations that you're having with CEOs of different and management and boards and regulators sometimes from various industries, various different countries, it gives you a perspective that is very unique to the finance industry. Which there's a trade-off with everything.
Wonderful. Yeah. So basically, it seems like this is the right sector for you if you want to end up affecting where money goes in all the other sectors.
Yeah,
it's pretty broad. Yeah, we have a couple of people also asking about resources. What are the best resources where do you learn enough to get the job in this space? Raik and Mehdi are asking this, but I'm just asking this on their behalf this time because we're limited in time.
Yeah, that's fine. Resources. You can start with some publications. So Responsible Investor is one. Environmental Finance is another. Some of the bigger news outlets also have their own kind of dedicated sustainability sections, like Bloomberg, Reuters. So just kind of getting your head around the news, who's doing what the industry looks like. Going to some conferences would probably be good if you want to start. Both Environmental Finance and Responsible Investor hold a lot of conferences in this space. Looking through the main industry associations, so the biggest one definitely is the Principles for Responsible Investment. For the investment side, there are two kind of sister organizations, all hosted by the UN, United Nations, which is Principles for Responsible Banking and Principles for Responsible Insurance. If you go onto those websites, then they have tons of tools. So the PRI has been around, I think, for 15 years now, maybe 20. And they have basically all the how-to resources you can think of. UNEP FI is another one. So UN Environment Program Finance Initiative is another one. There are two initiatives. One that's kind of finished its work really in 2017, called the Task Force for Climate-Related Financial Disclosures, TCFD, which has a hub with tons of different tools. So if you type in TCFD hub, it'll come up with tons of resources. The new one that's now live and is still in kind of production phase of a standard is the TNFD, which is Task Force for Nature-Based Financial Disclosures, which I'm actually involved in, and that's, as the name suggests, focus on nature, biodiversity, things like that. But they have, I think, a similar hub of resources that you can delve into. Between those, you'll be inundated.
Yeah, thank you. One last question. Let's try to give the answer to a couple of minutes because we need to stop after that. Yeah, I will let Josh unmute and ask his question.
Thank you. Really appreciate the talk you've given today. Yeah, my question is, what are the biggest issues with sustainability or ESG data providers right now, and what solutions would you like to see emerge?
Yeah, I guess perhaps like to add to that, just what are the major open problems in the space,
Oh, Jesus. Well, I mean, I think, as I mentioned before, the industry is going through a little bit of a shakeup because it's maturing. So there's, with the data providers specifically, there's an element of standardization in their approach, because apart from collecting data and aggregating data, which is what we use them primarily for. So as data aggregators, so we just want the raw data and we're going to assess it ourselves. But they also do the assessment for others. So they not only collect the data, but they score the data. So any company, and you can actually, MSCI, has an app, you can download it onto your iPhone, and you can just select a company like Coca-Cola, and it'll give you their ESG rating and the main issues that they've rated. And that rating, because it's a number, is treated currently by the finance industry a lot of the finance industry as being equivalent to a credit rating from the credit rating agencies like Fitch and Moody's and so on. But it's not, and it's actually fundamentally different. And a lot of people have kind of pointed out that the correlation between credit ratings is quite high, 99%, it's like very, very high. The correlation between sustainability ratings is very low. And I don't find that surprising at all, because I know how these ratings, the sustainability ratings, are built. The reason for that is that they're measuring different things. A credit rating basically is always measuring the probability of default. A sustainability rating could be measuring sustainability materiality overall. It could be measuring financial materiality only. So obviously you're going to get completely different answers based on just those two differences. But the way they arrive at a rating is also fundamentally different. So they'll maybe break up ESG into 50 different indicators, and they'll give them slightly different weightings, right? Because they think maybe climate change should be 20% of the rating for a specific sector, whereas a different data provider will say, no, actually it's 5%, or maybe it's 50%, right? And just based on that, you're going to have wildly different ratings, and that's fine. It's fundamentally just an opinion of the data provider, and no client should be using those solutions unless they believe and they trust in the methodology.
I think I may need to interrupt you here because we need to close in a minute.
Okay.
Yeah. Are you on Slack, Kajetan? Is it okay for people to perhaps send more questions to you there or no?
I think I am. Yeah, and feel free. If I'm not, I will be, and feel free to do that. Yeah, happy to answer some follow-up questions.
So we have a time-honored tradition for people to post one thing they learned on Slack, and I posted a thread on Learn the Space, on the Learn the Space channel. So please just post something you learned there, or if you have a question to Kajetan, tag him there with your question. And I guess at your leisure and availability, you may respond. Yeah, thank you so much for.
Will do.
Yeah, thank you so much for educating us, Kajetan, and thanks everyone for attending. See you next time.
Thanks for organizing, Eugene.
Bye.
Take care.